A lot of people have been asking the same question lately. Some high-end AI chip orders were put on hold in certain regions. It's a big headline. So why did Nvidia stock barely react? No big rally, no sell-off. The reason isn't that the market is numb. It's that this scenario has already been priced in. So today's video is not a recap of earnings. And it's not about explaining the headline itself. I want to focus on one thing only: how Nvidia is actually being priced by the market going forward. Welcome back to Deep Dive Stock Earnings. Today we're only talking about NVDA. If you've been watching Nvidia closely, you've probably noticed something strange. There's no shortage of news, no shortage of discussion, but the stock price just isn't reacting the way you'd expect. Today I'm not talking about short-term trades, and I'm not making predictions. I want to break down one core question: why such large potential upside and downside headlines haven't triggered much emotion in the market at all. Let's briefly walk through what happened. According to multiple major media reports, regulators asked some technology companies to pause purchases of high-end AI chips and encourage the use of domestic alternatives. Not long before that, the market had just heard that Nvidia had potential orders for roughly 2 million high-end AI chips, with a theoretical sales value close to $54 billion. If those orders were to fully materialize, even after accounting for additional taxes, Nvidia could still generate close to $40 billion in net revenue. That is not a small number by any measure. But here's the key point: those numbers were never included in the market's core pricing model to begin with. This is where most people get confused. Intuitively, $500 billion in potential orders should matter for the stock price. But the market doesn't price in what might happen. It prices in what is certain to happen. As long as the final step remains uncertain, even very large numbers can be treated as zero in valuation models. That's the foundation of how Nvidia is being priced right now. Whether you look at the company's own guidance or the models used by major analysts, they all assume zero sales from these potential markets. In other words, the current NVDA stock price reflects a version of Nvidia that does not rely on those orders at all. That's why you see what looks like a contradiction. When the order news surfaced, the stock didn't go up. When the pause news came out, the stock didn't go down either. From the market's perspective, this wasn't the loss of confirmed revenue. It was revenue that was never counted as confirmed in the first place. So the sideways price action you're seeing right now doesn't mean the market lacks direction. It means the market has already ruled out the most extreme scenarios. It doesn't get overly excited about low probability upside, and it doesn't panic over low probability downside. That's a sign that NVDA has entered a pricing and expectation management phase, not an emotion-driven trading phase. So what is the market actually focused on next? Not those potential orders, but the structure of growth itself. As customers move from simply grabbing buzz into a phase of evaluating return on investment, the focus shifts away from shipment speed and toward unit compute cost, system efficiency, and long-term depreciation cycles. Once the evaluation standard changes from how fast to how efficient, valuation multiples tend to compress first, even if revenue continues to grow. That's why Nvidia stock feels less smooth than before. It's not that demand has disappeared. The pricing framework has changed. Some people interpret this phase as the market losing confidence. I see it differently. The market is waiting for evidence. If the next set of evidence is clear enough, price movement will come quickly. But before that confirmation arrives, capital would rather move sideways than bet early on a direction. So what truly determines the next leg of the stock isn't any single headline. It's whether upcoming guidance over the next few quarters can answer a few key questions. Can data center revenue continue to grow steadily on a high base? Can margin structure hold up as scale expands? And as demand shifts from training toward inference, do orders become more recurring and more diversified? If those questions are answered clearly, the market will naturally accept a more mature, but still high-quality growth profile. The current consolidation isn't wasted time. It's the market filtering for consensus before the next repricing. To sum it up in one sentence, these potential orders are not a risk to Nvidia, they're an unexercised option. The current stock price reflects a version of Nvidia that does not depend on those uncertain variables. What really matters from here is growth cadence and margin structure. Do you think the market is being conservative, or has it already priced this correctly? Let me know in the comments, and I'll see you in the next video.